Welcome to the FedLife podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello and welcome to this episode of the FedLife podcast. Once again, I am your host, Dan Sipe. Additionally, I'm the branch manager here at the Serving Those Who Serve and Sipe and Associates, beginning as I always do by saying thank you. Thank you for taking the time to listen. And above all, thank you for your service to the government, to the country, to me, to everyone. You do not hear that enough. You'll always hear it here. The other thing you'll always hear is Ed Zurndorfer. He's back with us again. Yes, the guru is here as part of our ongoing mission to reach, teach, and serve you, the career civilian Fed. At the outset, I need to say that the opinions of our guest Ed Zurndorfer are not the opinions of Raymond James or Serving Those Who Serve, and this podcast is presented for information only and is not intended to be taken as advice. All listeners should consult their personal advisors before taking any action, and if you don't have a personal advisor, hit us up at stwserve.com. We will help you any way we can. Folks, as you know, we try and follow Ed's FedZone articles, and we are continuing in a series that pretty much covered the whole month of May. I know I'm not supposed to talk about times and dates in podcasts, but I break that fourth wall all the time. I'm like Deadpool. So here we go. And we are covering inheriting an IRA from somebody other than a spouse. So for example, your folks leave you something. And in our previous episode, we talked about the rules and regs and how they've changed for doing it for traditional IRAs. That means mom or dad got a tax deduction for putting the money in. It's fully taxable when it comes out, or it could be an after-tax IRA for that matter. But what it's not is a Roth IRA. And those have become incredibly popular. We're going to see more and more people inheriting them. So Ed, let's go ahead and kind of jump right in where we left off. You know, one of the big things that changed as a result of the various Secure Acts is this idea of having 10 years to take distributions if you're a beneficiary. So if you are just jumping on this this podcast and you didn't listen to the previous one, go back and listen to it, because otherwise you're going to be a little bit lost. So, Ed, now we're in the post Secure 2.0 Act, Secure 1.0 Act, and somebody has inherited a Roth IRA. Previously, they could stretch it over their whole lives and it'd come out tax-free. Now, it's a little bit different, correct?
That is correct, Dan. Roth IRAs are different in the following sense. Roth IRA owners are never subject to required minimum distributions.
Mm-hmm.
They're not. You can a Roth IRA owner can keep that money in a Roth IRA indefinitely. I always use the term that a Roth IRA owners are deemed to have died before the required beginning date.
Sure.
If
Gotcha.
you get for example, a Roth IRA owner who's 100 years old,
Yes.
they're still deemed to have died before they reach their RMD.
Gotcha.
Their required beginning date. But I will tell you that is not the case when when an individual inherits a Roth IRA.
Mm-hmm.
The Roth IRA owner named someone as beneficiary of their IRA, and that person, unless it's the spouse, is required to take out the amount that they inherited, the Roth IRA. They have to take out a certain amount each year, tax-free, or they can take it out in a whole lump sum and not pay tax. So they have that. There's no RMDs required even for those individuals who inherit Roth IRAs. Now, However, under Secure Act 2.0, and I said someone who inherits a Roth IRA is not subject to RMD. And let me correct that. I'm sorry. I'm talking about eligible designated beneficiary. Who is an eligible designated beneficiary? A spouse, someone, a relative who is, let's say, is to anyone, including a relative who's no more than 10 years younger than the Roth IRA owner. Anybody else who is considered to be a non-eligible designated beneficiary of the IRA, and when they inherit a Roth IRA, they are going to have to take the money out of the Roth IRA by the end of the 10th year following the death of the Roth IRA owner. They're subject to that 10-year rule we talked about when we talk about traditional IRAs. One difference, though, no matter when the Roth IRA owner died, the non-eligible designated beneficiary is never subject to any RMD. They don't have to take anything out during years 1 through 9. They take the whole thing out at the end of year 10. As long as they clean it out by the end of year 10, they're fine. But there's no RMD. Now we're talking about the Roth IRA here, Dan.
That is a difference.
It probably is in the best interest of the non-eligible designated beneficiary to wait as long as possible to take the money out of the Roth IRA. Why? Because we're talking about continued growth, tax-free growth.
Yep.
And it really is to the advantage to wait as long as possible. But once again, they do not have to do that. Let's say that the non-eligible designated beneficiary is all of a sudden has a very subject to a major expense. I use the example of a nursing home, or maybe they have some kids going to college. They need a lot of money. They need a lot of money to help pay for their child's college education. Well, they're free to cash out that inherited Roth IRA anytime within the 10 years and not pay any tax. So again, the Roth IRA owner has a lot more flexibility than the traditional IRA owner, in the sense that the inherited IRA owner, they could cash it out, the inherited traditional IRA, anytime during the 10 years, but they got to pay tax. And if we're talking about a lot of money in that payment, in that lump sum payment, it could push them into a higher tax bracket. Not the case with the inherited Roth IRA.
Gotcha. Now, in your article, you talk about the consequences of missing and penalties. How do they differ with Roth versus the traditional?
Well, with the Roth IRA, because the Roth IRA is never subject to any RMD or any RMD, an eligible designated beneficiary certainly is not going to be subject to any type of penalty for not taking the money out. But in the case of the non-eligible designated beneficiary, if they do not take it out, and they miss that 10-year mark, then they're going to be subject to a now under Secure Act 2.0 a 25% IRS penalty.
Gotcha.
If they correct it within 2 years, the penalty will be reduced to 10%.
So to clarify there, Ed, for our listeners, so somebody's non-EDB, so they're just the rest of the folks out there,
right?
And they've elected not to take anything out until the 10th year. They can clear it out in the 10th year, and they're not going to have any penalties. Is that correct?
Correct.
Now, if they miss the 10th year, do they have 2 years to correct it?
And be subject to it could be reduced to 10%. But I can tell you, Dan, that it's been my experience, especially over the last couple of years, that the IRS does have a heart and soul in the following
Okay,
sense.
that's good.
That if in this case, the non-eligible designated beneficiary, okay, can request a waiver of penalty by filing a form. And that form is IRS form 5329. Additional taxes on qualified plans, including IRAs and other tax favored accounts. And that's where that 25% or 10% penalty would actually be calculated. But on that form, there's a part 9 in which the person who is subject to penalty can write a reason why they missed taking out an RMD. And the IRS usually says, we accept your reason, and they drop the penalty.
Gotcha.
Okay.
That is good. That is good to hear and good to know, Ed.
I just want to say the IRS was asked a question: can the penalty for not taking the full inherited IRA RMD be waived? The IRS responded, yes, the penalty may be waived if the account owner establishes that the shortfall in distribution was due to a reasonable error and that reasonable steps are being taken to remedy the shortfall. In order to qualify for this relief, the individual subject to the penalty must file, once again, IRS form 5329, part 9, and attach a letter of explanation.
Gotcha.
I've had experience with this. I had an individual who missed, I think, or had a shortfall at least of RMD. They didn't take out their full RMD. This goes back to the year 2019. I think between the years 2010 and 2018, he missed a good portion of his RMD. And for the portion he missed, he was subject to that 50% penalty.
Mm-hmm.
Well, we fixed his taxes. We fixed his tax return, including what it should have been taken out. He had to file the taxes and pay and include the additional income of that RMD. And when it came to IRS form 5329, I wrote an explanation each time why he missed it, and there were some good reasons.
Sure.
He said he had a lot of medical problems in a couple of years. He had to go to doctors. He didn't have time to request the full amount of his RMD. His wife was sick a couple of years. We wrote every year that he missed that the portion of his RMD. We filed the form IRS form 5329. We filed amended returns, including what should have been taken out. And Dan, the IRS did not impose any penalty for all, I think it was 9 years.
That's awesome. That is a great story. Hey, Ed, I want to loop back here like I did in the other one, because, this is close to my heart. Going back to those eligible designated beneficiary, special needs child who's been disabled from birth, that type of thing, they would be an eligible designated beneficiary regardless of their age difference, correct?
That's correct. That's correct.
Okay. Yeah. So folks, that's important, because, special needs planning is a real thing, that parents are laying out for looking out for their children into the future. If you're a regular listener, it's something personally close to me. My late father-in-law was a retired Fed. He had a developmentally delayed special needs daughter. She lives with us. My wife is her guardian. So, I always like to clarify that part for folks. So,
I just want to mention one thing, Dan, about that. You mentioned about special needs child. I would advise that in the case of a special needs child inheriting an IRA, and that special needs child, let's say the child's getting Social Security SSI, they might lose eligibility for that if their income goes up.
Oh, yes.
That they're advised to the parent, whoever's the custodian of the child, should work with both an accountant, maybe an attorney, who will come up with a strategy as to what is the best way for the child to take this money from their inherited IRA to take the money out so as to minimize the possibility that they may lose some of their SSI.
100%. No, that's a great tip, Ed. Okay, so I think we've pretty well covered. And folks, head over to the Fed Zone, fed-zone.com. All right, Ed has pictures of the forms and everything in there. Nobody is more thorough on this stuff than Ed Zurndorfer. So head over and if you want to listen to this, read there. If you want to read along, whatever works best for you. But be sure to hit the Fed Zone itself on that, because the examples are fantastic. All right, so Ed, we're kind of rolling up to your final article in the series, and again, this is so vintage Ed Zurndorfer, because he's looking at the things that a lot of people aren't going to consider. And so the first one up is, what are the payout requirements if a successor beneficiary inherits from a deceased beneficiary? So stay with me, folks. Can't tell the players without a scorecard. So I don't do examples as well as Ed, but I'll throw one out here. So somebody inherits an IRA from mom or dad. They're following their rules for taking their distributions, and then they die. Well, what you might not realize is they probably set up an account with the beneficiary. So now there's a beneficiary for the beneficiary. Okay, was that an okay explanation, Ed?
Yes, Dan, very good.
All right, now take us through what happens there.
And I wanted to say something up front about, when Congress passed Secure Act 2.0, that was the first thought that came to mind. Well, that's great for the original beneficiary, but what happens when the original beneficiary dies?
Sure.
I was looking for months. I couldn't find anything on IRS website, congressional, laws that were, all this information you get off the congressional website about proposed legislation, saw nothing. Well, finally this spring, IRS came out with the guidance. So, and I was all excited to write this stuff up, because now everything is complete. Okay.
Absolutely. So let's jump in. So the beneficiary of the beneficiary, what are the rules?
All right. So under Secure Act 2.0, once again, it was passed this past December, took effect January 1st, 2023, a successor beneficiary. And who's the successor beneficiary? That is the beneficiary of the original named beneficiary of the inherited IRA. Here, the original named beneficiary decided, well, what happens when I die? I better name a successor beneficiary. Okay. So when the successor beneficiary takes over, he or she is subject to the 10-year rule period. It makes no difference if the successor beneficiary is a spouse, is disabled, because you were asking earlier, Dan, about someone is disabled, or could otherwise qualify as an eligible designated beneficiary.
Gotcha.
The 10-year period will be either a new 10-year period or the continuation of an existing 10-year period.
Ooh.
Okay. Getting a little more complicated here, Dan, huh?
Sure, absolutely.
What I mean by that is, let's say RMDs were being taken by a previous account owner.
Mm-hmm.
Okay, annual RMDs were within the 10-year period are required by the successor beneficiary. In other words, the original beneficiary was subject to the 10-year rule, of course, and had to take RMDs during the 10 years because the original traditional IRA owner had reached his or her required beginning date.
Gotcha.
Okay, so they had to take RMDs themselves. So let's talk about different scenarios here. That's the best way to do this. Different scenarios.
Gotcha.
Okay. Scenario number one. The original named beneficiary was an eligible designated beneficiary and therefore was able to stretch their annual RMD payments over their own single life expectancy. In this scenario, the successor beneficiary will get the benefit of a full brand new 10-year payout period.
Okay.
RMDs will apply in years 1 through 9 based on the original beneficiary's single life expectancy.
Oh, wow.
And what that means in sort of short, real flat terms here, the successor beneficiary essentially is stepping into the shoes of the
Gotcha.
original beneficiary and continues the same RMD schedule for years 1 through 9 using the same RMD factor, -1 each year. It always helps to do an example, right, Dan?
The examples are fantastic, Ed. So,
I love those examples.
and I do too. So go ahead and shoot.
All right, here we go. We have someone named Jerry. Jerry owned a traditional IRA and named his wife Francine as his sole beneficiary.
Mm-hmm.
Now, Jerry died at age 69. Francine was age 63 at the time of Jerry's death. Jerry died on July 15, 2020. Francine, as a spouse, is an eligible designated beneficiary. And Francine, as such, elected to stretch her inherited IRA from Jerry over her life expectancy. Okay?
Gotcha.
Shortly after inheriting Jerry's traditional IRA, Francine named a successor beneficiary, their son Randolph. Now, because Jerry died in 2020, Francine's, now again, she's taking the inherited IRA and she's stretching it over her life expectancy. She has to take out each year a minimum amount. That's what's called Francis's RMD of the inherited IRA.
Gotcha.
When was the first one due? December 31st, following the year that Jerry died, which is December 31st, 2021. The
Gotcha.
RMD was based on the inherited IRA balance as of December 31st, 2020. That's the year that Jerry died. And Francis's single life expectancy factor for a 64-year-old. Why 64-year-old? Because in 2020, that's when Jerry died, Francis was 63.
Gotcha.
I'm sorry, Francine. Now it's 2021. Francine is 1 year old. She's 64.
Makes
Francine
sense.
goes to IRS publication 590-B. That's individual retirement arrangements, distributions, table 1, which is found actually in Appendix B of IRS publication 590-B. And she finds that the single life expectancy for a 63-year-old is 23.7 years.
Mm-hmm.
So Francine got that first, and she divided that, she did the calculation. She got that first RMD in November 2021. So she met the first year RMD because received it before December 31st, 2021. But then Francine died suddenly on March the 10th, 2022. Now, Randolph has been named as a successor beneficiary.
Mm-hmm.
He's going to be required to withdraw the balance in the inherited IRA no later than December 31st of the 10th year following the year of death of Jerry, not Francine. That is
Wow.
no later than December 31st, 2000, and no later than December 31st, 2030.
Wow.
Randolph is subject to RMDs
Sure.
during years 1 through 9. How is Randolph going to calculate his RMD each year? Randolph is going to step into the shoes of his deceased mother and continued the same RMD schedule.
Wow.
So for the first year, this is that he has to take his first RMD. That's 2023. Randolph will look at the inherited IRA balance as of December 31st, 2022. What's going to be Randolph's life expectancy factor? 22.9. Why 22.9? Because that was Francine's life expectancy during the year 2022, that the year that she died.
Gotcha.
-1, because we're talking, that's because she died in 2022. This is 2023. So now it's going to be 21.9. So do the calculation. Account balance as of December 31st, 2022 divided by 21.9 will be the RMD for the year 2023. What about 2024? Randolph will look at the IRA account balance as of December 31st, 2023. What's going to be the life expectancy factor? 21.9 -1. Remember, the 21.9 was for the year 2023.
Sure.
So now we're up. Now we're going to subtract 1. Now it's up. Now 21.9 minus 1 is 20.9. And for years 5 through 9, you do it the same way. During year 10, 2030, Randolph has to withdraw the entire remaining balance in the inherited IRA no later than December 31st, 2030.
Wow. Well, folks, if your head is spinning, you're in good company. Anytime they do things with the tax code, Ed, I think it should be called the lifetime employment guarantee for financial advisors and accountants.
Especially accountants.
Up on this stuff. So that was if it was an EDB. So let's go to scenario 2, where the original beneficiary is already using the 10-year rule, because I think this is going to be a surprise for some people.
Yeah. If the original beneficiary, the inherited IRA, was already using the 10-year rule, then the successor beneficiary has to continue the same time on that 10-year period. There's no reset of the 10-year period. In other words, they're going to step in the shoes at the point where the original beneficiary died. Okay. If
Gotcha.
the original beneficiary was not subject to RMDs during the 10-year period, then the successor beneficiary need not take RMDs. Let's look at an example here. Helps to do an example. So we have Peter. He was the owner of an inherited IRA when he died on April the 30th, 2020, at the age of 67. He had named his daughter Gloria as the sole beneficiary of his inherited IRA. At the time of Peter's death, Gloria was 42 years old and was therefore a non-eligible designated beneficiary.
Gotcha.
Subject to the 10-year payout rule. Shortly after inheriting Peter's inherited IRA, Gloria named her son Frank, age 19, a successor beneficiary of her inherited IRA. Gloria, again, was subject to the 10-year payout rule with the inherited IRA to be paid out no later than December 31st, 2030. Remember that Peter died, her father died on April the 30th, 2020. So she has to get it all out of there. Has to withdraw it no later than December 31st, 2030, but she doesn't have to take RMDs. She just has to clean it out by the end of 2030. She actually took her first distribution from her inherited IRA in 2021. Since Peter died before reaching his required beginning date, Gloria was not doing RMDs and not subject to doing the terrain, but she took some money out during that first year.
Mm-hmm.
But then Gloria died on August 14, 2022. Frank, the successor beneficiary of the inherited IRA, must complete the payout of the inherited IRA no later than December 31st, 2030. In other words, he's just going to step in where Gloria left off.
Sure.
Okay.
Gotcha.
So,
wow. Folks, I don't know where else in the Fed space you're going to go and find this. That's my throwdown comment on that. So thankfully it's here because we've got Ed. All right, Ed, we got 2 other points to wrap up here, and the other has to do with can can qualified charitable distributions come out of inherited IRAs?
Let's just review again what a qualified charitable distribution is. QCD for short. It's a distribution from a traditional IRA to a qualified charity.
Mm-hmm.
And who can make QCDs? Anybody who is over 70 and a half. Now, what's the benefit of QCD? Okay. As I say, the money coming from is coming from a traditional IRA to go to a qualified charity. Now, the good news is that when the money comes from a traditional IRA to a qualified charity, one normally would pay tax when take money out of traditional IRA, but this case you will not pay tax, provided that the IRA plan actually writes the check out and sends the check to the charity. In other words, you cannot write a check out from your own traditional. The money has to come from the IRA plan made out to the charity from the traditional IRA from the traditional IRA on behalf of the traditional IRA owner. Okay, that's the good news. No taxes due. Another good part, another good aspect of a QCD is that if the traditional IRA owner had reached his or her required beginning date and must take RMD from the traditional IRA,
Mm-hmm.
the QCD can fulfill the RMD requirement. Suppose someone had an RMD in a given year of, let's say, $8,000.
Mm-hmm.
And they have some favorite charities. It doesn't have to go all to one charity. They have a church, they have the Goodwill, they have the American Cancer Society, and the person wants to give money to all of them.
Mm-hmm.
QCDs can make to all the charities from the person's IRA, traditional IRA or traditional IRAs. They may have more than traditional IRAs, and the total distribution is going to charity equals $8,000.
Gotcha.
They have fulfilled their RMD requirements for that year.
Nice.
And normally, Dan, when you take money out of an IRA, you have to pay tax. The person's not going to pay tax, federal or state, nor is it included in their income. So if the person, and they're over 70 and a half, they got to be over 70 and a half, is probably enrolled in Medicare Part B, what you pay for Medicare Part B includes all your income. And that would include a traditional IRA RMD, but not in this case. So by performing these QCDs, a Medicare Part B enrollee could end up paying less in a given year for Medicare Part B, because that part of their income would normally be included in your income is not. And as we talk about that during our FEHB and Medicare webinars, there are things you can do to minimize your Medicare Part B monthly payments, monthly premiums. Now that's the good news. Now comes the bad news. Very good.
Oh, no, it's always bad news. Go ahead, Ed.
Normally, when you write a check out to a charity, do you get a charitable contribution deduction on your income taxes?
I do.
Well, in this case, you're not. I call it, you can't have your cake and eat it too. It's not going to be included in your income. It's not going to be included in your income.
Sure.
But you're not going to be able to write it off as a deduction.
No, I got you. And, question here, Ed. QCD, that's basically above the line, right? It reduces the overall income, whereas a charitable deduction is always going to be below the line. So does that?
Got to be careful here, though, because the QCD is not an adjustment to your. It's just not included in your income.
Gotcha. No, I'm tracking.
You asked a question about as far as the charitable contributions are below the line. Yeah, if you itemize.
Gotcha.
Let's think about this for a moment, Dan. When you're over 70 and a half, what are the chances that you're going to be itemizing?
Good point.
I mean, you might have maybe some medical deductions. Probably do not own, you're not paying a mortgage. Your state and local taxes are limited right now under the current law, are limited to $10,000. And because under the Tax Cuts and Jobs Act of 2017, the standard deduction has been doubled, most people today are actually taking the standard deduction. So
Sure.
in fact, they wouldn't be able to get any benefit from a charitable contribution.
No, that makes sense.
So that's one way of looking at it. Now,
Gotcha.
I guess the question in hand here is that if one is over 70 and a half and they're intending to make a QCD, it has to be made from a traditional IRA. You cannot make it from a Roth IRA. Suppose this person who's over 70 and a half actually inherited a traditional IRA. Let's say from a spouse, from a sibling.
Yep.
The IRS was asked the question, can someone make a QCD from an inherited IRA? I'm happy to report, Dan, the answer is yes.
That's good news.
IRS said absolutely yes. You can make a QCD from an inherited traditional IRA with the understanding that the standard QCD rules still apply. What is the main rule when it comes to QCD? You have to be over 70 and a half.
Gotcha.
Okay. That is the inherited IRA beneficiary. Okay. It's not good enough that the original IRA owner from who the beneficiary inherited the IRA was over 70. The current inherited IRA beneficiary, they have to be over 70 and a half in order to do a QCD. Let's do an example here. And I had that also in the Fed zone column I wrote.
Yep.
We have someone named Ivan. Ivan's 76 years old, and he named as his traditional IRA beneficiaries his younger siblings. He has a sibling named Carol, who's age 74, and Sheldon, who's age 68, and each is a 50% beneficiary. Now, Ivan died, and Carol inherits her 50% portion of Ivan's traditional IRA. She can make a QCD from her inherited IRA, but Sheldon cannot. Why can't Sheldon? Because he's only 68. He has to wait until he's 7 and a half to make a QCD from his inherited IRA.
Makes sense.
Once again, Dan, as I think I mentioned earlier, that we're talking about when it comes to the traditional IRA, when you inherit a traditional IRA, you have to take the money out. Each year, you have to take out something. I mean, and if we're talking about in this case siblings here who are within 10 years of their deceased sibling, because he's 76, and Carol's 74, and something. Carol and Sheldon can take it out over their life expectancy. But they still have to pay tax. They still have to pay tax on the amount that they're taking out on their RMD, on their amount they're taking out each year. They got to take out some each year, and that's going to be including their income. By making a QCD, they can fulfill their RMD every year this way. That's the beauty of it.
Absolutely. Absolutely.
That's included in income.
Yep. Okay, Ed, let's take us home with your last topic, which was, does an inherited IRA have to be considered when applying the IRA pro rata rule? So if
Yeah.
you've got all these IRAs all over the place, does this factor in for that?
Let's just briefly talk about what the pro rata rule is.
Sure.
The pro rata rule dictates that all lifetime traditional IRA accounts, that includes contributory IRAs, the ones you contribute to a traditional IRA. You might have a SEP IRA. You might have a simple IRA. Okay. All those IRAs have to be considered in order to properly calculate the taxes on certain IRA transactions.
Mm-hmm.
Such as, and this is the one that a lot of people love to do this, converting a traditional IRA to a Roth IRA.
Yep.
When you convert a traditional IRA to a Roth IRA, you have to pay tax.
Mm-hmm.
Pay tax on what? Anything in the traditional IRA that has never been taxed. So what does that include? Always earnings, the accrued earnings, never been taxed.
Yep.
What about contributions, Dan?
Yes.
It depends.
Yep. It depends on whether they're pre-tax or after-tax.
That's right. Because over the years, people have made what's called non-deductible traditional IRA contributions. What do I mean by non-deductible? The contribution that they made was already taxed, as opposed to a deductible traditional IRA contribution in which the contributions that were made resulted in a tax deduction. So what the IRS says is, if you want to convert a particular traditional IRA to a Roth IRA, you cannot just look at that one traditional IRA to see if it's pre-tax or post-tax in terms of whether it's deductible or non-deductible. You got to look at all your IRAs in order to come up with what is called a cost basis.
Yep.
A cost basis. Yes, it is complicated, and I advise anybody who wants to do a conversion of a traditional IRA to a Roth IRA, please talk to a qualified tax professional. You could end up really hurting yourself.
Sure.
Okay, you do this on your own. I cannot tell you the number of tax returns over the years I've had to amend, Dan, because people try to do this on their own, converting a traditional IRA to Roth IRA, and they came to me to get their taxes done. I said, guess what? You've got a problem here. You didn't do it right.
Yeah.
Oh, what did I do wrong? And they really regret it, not asking me first before they did it, what to do. Well, the issue at hand here is, what about someone inherits an IRA?
Mm-hmm.
They inherit a traditional IRA. Is that going to be included in terms of the pro rata rule, including what I just said, traditional the IRAs that are included in the pro rata rule, or your contributory IRAs, which you contribute to, SEP IRAs and simple IRAs, but inherited IRAs are not included as part of the pro rata rule.
That's good news.
Nor are, if federal employees have a thrift savings plan, the TSP, is that going to be included as part of the pro rata rule? Nope. How about if you have a 401k plan? Nope. 403b plan? Nope. Okay. So that's for individuals who work in private industry. They are not included as part of the pro rata rule. Only, again, your traditional IRAs that you contributed to. Maybe you work for an employer who had a SEP IRA, or maybe you're self-employed at SEP IRA, or a simple IRA. All those type of IRAs are included in in using the pro rata rule, but not inherited IRAs.
Gotcha. Well, that's a great place for us to wrap up today, folks. And Ed, once again, brother, you are a national treasure, especially for our feds here. This level of detail, I just don't believe they're finding anywhere else. Thank you.
My pleasure.
Well, folks, that's a wrap. Don't miss us next time around for our new look, new fit, feel, finish We got some exciting things coming with the podcast. Check us out for that. We're very excited about it. We are serving as a serve. Be sure to subscribe to this podcast on our YouTube channel. Nothing will change there. Also on Spotify. Remember to share it with friends and strangers. Check out our website, sdwserve.com, and don't forget those live webinars every single week. You will see the webinar button, click on it. It'll take you to the landing page. You'll see the whole menu. We've got tons. The guru comes to you. Reach you where you are, teach you where you are, serve you. Sign up for one, sign up for all, sign up for a multiple of the same. We don't restrict you, and we don't restrict by age. Any age, all are welcome. Be sure to read Ed every week in the Fed Zone. That's fed-zone.com. Be sure to subscribe to the weekly serving, where you'll get the best of Ed and the other stars, the Fed stars from Serving the Serve, coming to you straight to your inbox. So for Ed, the crew at Serving the Serve, and me, Dan Sipe, closing out as I always do by saying, good luck, Godspeed, and above all, remember, it's your Fed life. Make it a great one, because you deserve it. Stay well, everybody. We are out.
Thank you for listening to the FedLife podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary. Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations.
Neither Raymond James Financial Services nor any Raymond James financial advisor renders advice on tax issues. These matters should be discussed with the appropriate professional. Investing involves risk, and you may incur a profit or loss regardless of strategy selected, including diversification and asset allocation.